Welcome to the M&S Tax Efficient Savings video. In this video we will give you an overview of the tax allowances and tax-free savings accounts that can reduce some or all of the tax you have to pay on your savings. When you receive income on your savings, you may need to pay tax on it. This can include interest from savings. However, there are a number of allowances and tax-free savings accounts that allow interest to be tax-free. There is a type of savings account called an individual savings account, commonly known as an ISA. There are several types of ISAs available, but the most well-known is the cash ISA. Any interest you receive on savings held in a cash ISA is free of tax. There is a limit to the amount you can pay into a cash ISA each year, starting from the 6th of April and ending on the 5th of April of the following year. The limit occasionally changes, so you should click the link on the next steps below this video to check what the current limit is. Like other types of savings accounts, the way interest is paid can vary, with some cash ISAs paying a fixed rate and others offering variable rates of interest. You can learn more about the different ways interest is paid by watching the video Types of Savings Accounts. The interest you receive will vary between different providers. You should shop around to make sure you're getting the best rate. There are other types of ISAs available, including stocks and shares ISAs and lifetime ISAs. These accounts also have limits on how much you can pay in each year. Click on the links below on the next steps at the end of this video to find out more. In a stocks and shares ISA, you can hold investments such as funds, bonds or shares in companies, and income or growth on these investments is tax-free. These would usually form part of a long-term savings plan, typically for 5 years or longer. We explain more about this in a separate video within this topic titled Investing. In the lifetime ISA, investment returns are tax-free, and in addition, the government pays a bonus of 25% on money you've paid in. Lifetime ISAs are specifically designed to help people fund the purchase of their first home or to use to help fund their retirement from the age of 60. However, charges apply if money is withdrawn at any other time. You must be under 40 years of age to take out a lifetime ISA and cannot save into the account after reaching 50. The annual contribution limit is lower than for other types of ISAs. If you are looking to save towards your retirement, a pension plan can be a good way of protecting your savings from tax. Subject to limits set by HMRC, you don't pay income tax on savings you make into your pension. If you make contributions into your employer's pension, such as your M&S Pension Savings Plan, your employer will also contribute into your savings. The contributions that you and your employer make are invested, and any income or growth from these investments is also free of tax. Unlike other types of savings accounts, there are strict rules about when you can access these savings. You normally have to be over the age of 55, but it can be earlier than this if you are suffering ill health. When you do access these savings, you can receive up to 25% tax-free. Any remaining savings you withdraw are taxed as income. Whilst the returns on your savings are protected from tax in an ISA or pension, tax may apply to interest from other types of accounts. Savings held with a bank or building society receive interest paid gross, meaning that tax is not deducted by the bank or building society. However, you may still be liable to pay tax on this interest. If you have a joint savings account, the interest is normally evenly split between the account holders. There are currently 3 tax allowances set by HMRC which may reduce or remove the need to pay tax on this interest. The first of these is your personal allowance. This is an allowance that allows most people to receive a certain amount of income before they start paying income tax on it. If all your income, including interest, falls within your personal allowance, you won't need to pay tax on it. If your salary is more than the personal allowance, then you may be able to use the personal savings allowance to give you more scope for tax-free savings. This means that, in practice, most people don't have to pay tax on interest they receive. The starting rate for savings is an allowance that's specifically aimed at helping savers on low incomes. If your salary is above a certain level, this allowance won't be available to you. You can find out more details about these allowances by following the link in the next steps that follow this video. If you exceed all allowances available to you, you'll need to pay income tax on the interest you receive. The rate of tax depends on your total income. Banks and building societies provide HMRC with information on the interest you receive. HMRC will then calculate whether you need to pay any tax due. Tax due on savings interest is normally collected automatically through your tax code. You will receive a letter from HMRC if this applies to you. They may also ask you to complete a self-assessment, which will detail all sources of income you have received, including any interest. If HMRC collect more tax than you owe, you can claim back overpaid tax by completing Form R40, which you can access from gov.uk. Finally, another type of tax-efficient savings is premium bonds. These are issued by National Savings and Investments and are fully backed by the government. You can earn tax-free prizes between £25 and £1 million in the monthly draw, although there's only a very small chance of winning a high prize. You won't earn any interest, so although your savings are guaranteed, they are unlikely to keep pace with the rise in the cost of living. As there is no certainty over the prizes you could win from premium bonds, they are unlikely to be the best savings product for you if you want a guaranteed return. This is the end of the Tax Efficient Savings video. Please click the next steps below the video to learn more and use the knowledge checker to test your learning. Please be aware that this video is provided for illustrative purposes. It is not intended to be used for financial planning and does not constitute financial advice. Whilst every effort is made to ensure the accuracy of information contained in the video, it cannot be guaranteed.